Today we'll be looking at Silver Lake's acquisition of Electronic Arts, also known as EA Games. Note, this is not a financial or investment advice, and content is only for educational purposes only. A bit late to this one, given the acquisition was announced back in September 2025. One of the biggest LBOs announced in the tech sector, and especially in the gaming sector to date. Approximate deal value was around $52 to $55 billion. And so today, what I'm going to do is show you how an investment banker would approach the LBO analysis, whether that be for a pitch or post-deal analysis of what Silver Lake has done, and just try and get a good understanding of the economics behind the entire deal. Similar to my previous videos, my preference is to grab all the historical numbers from the annual report as a starting point. And for simplicity, what I've done here is I've just taken the FY25 report. Here I've just taken an old template, and what I'm doing now is changing the line items to match specifically for EA Games. And for those of you who don't want to see this and want to skip ahead, please feel free to do so. But remember to like and subscribe if you found this video to be helpful. And for those of you who don't know, EA Games owns some of the biggest gaming titles in the world. For example, EA Sports, Madden NFL, Apex Legends, Sims, Battlefield. So really a premium, big, global company that has had a lot of success across multiple gaming platforms. When grabbing the historical financials, it was very clear that EA Games did not have a lot of borrowings on its balance sheet. So for Silver Lake, this would have been an opportunity to leverage up and optimize the financial structure of the company. Within the P&L, the two largest expense items are cost of revenue and research and development expense. Now, cost of revenue relates to royalty expenses as well as costs associated with distribution of the game through PlayStation Store, Microsoft stores. R&D costs, on the other hand, are specifically costs associated with the development of their own games. Once the historicals are completely filled in, the next step is to actually build out the forecast, or what we call the operating model. And typically what you will do is you would have a few years of historicals, and then you will have a few years that are projections. And typically you will do this for the P&L, balance sheet, and cash flow. Now, as an investment banking associate who's seen this several times, I can tell you that sometimes on the job you don't have the time to do this, because sometimes client requests come in fast and you don't have all the information or detail, and it's just sometimes not worth spending that much time to do all of this. From an educational point of view, hopefully this is interesting and makes sense to everybody watching. And typically on the job, what we do is we usually just grab the few main items and use that as a driver for all of our models. But noting that during a transaction, you would definitely need to build out something that is even more detailed than what I'm showing you today. Once I've built in a few of the line items, you can see here what I've done is, for the smaller items that don't really drive valuation, for simplicity, I've just flatlined these, because you can forecast all of these and have schedules, but in reality, they aren't going to make a difference. And so we just want to capture the key points. And usually your next steps would be to build the key drivers in a separate tab. But here what I've done is I've just kept it simple by building it on top of the actual operating model. And most of this would be driven as year-on-year revenue growth and percentage of revenue. I think in this case it works really well, just given how consistent the financials have been for EA Games. What's interesting about EA games is that a lot of the revenue is actually from in-game purchases and in-game subscriptions, which is around 270-80% of the total revenue from games. We then begin to link some of these drivers into the actual operating model for the forecast period. Given that a lot of the cost items are relatively stable as a percentage of net revenue, what I've decided to do here is to just take the average across the historical period. And so when you look at cost of revenue, it's been pretty consistent around, 20%. You look at R&D, it's been pretty consistent around 32%. The other line items don't matter as much, but for completeness, I've kept these in. And for tax rate, I've used the actual effective tax rate. And I've done the same thing for the balance sheet, where I've just taken a simple assumption based on revenue. There are specific line items that we do need to build out with proper schedules. And you will see that I've built these below the cash flow statement. And some of the key ones that we're going to have are, I know I've written PPE here, but actually the major one would be not only PPE, but goodwill and the acquisition related to intangibles. And a lot of this would include game development as well as existing acquisition intangibles that need to be amortized over the forecast period. Spent some time on this given that DNA is a pretty meaningful impact on the cash flow when we do our valuation. And it took me a while to realize, but the way that EA has actually laid out their financials is that depreciation and a part of amortization is actually baked into the cost of revenue as well as the operating expense. So the explicit amortization line isn't representative of the entire amortization amount. To save some time, what I've done is I've skipped ahead to where I have already completed the schedules based on the disclosures in the annual report. And what I'm doing here is that I'm trying to back out the amortization that is already included in the cost of revenue and operating expense in the P&L. And EA Games actually gives you a forecast estimate of what they think the amortization is going to be for their acquired intangibles. And this is really to avoid double counting of the amortization because the key drivers assumes a percentage of net revenue, and these assumptions already include a proportion of amortization. Next, we look to build out the PPE schedule. The PPE schedule includes that software development component, which is interesting because typically you would include it under intangibles, but for EA Games, this is included under PPE. And what I've done here is I've taken the guidance from the annual report and included the depreciation amount that they've historically stated. And then we back solve the CapEx amount to get the closing balance to equal what is being shown on the balance sheet. Management provides a CapEx guidance figure for FY26, and I've just used this as a placeholder for now. Typically, when an acquirer takes over a company, you can expect these numbers to change, but we can discuss about this later. And for the purposes of the remaining forecast period, once again, I've assumed CapEx as a percentage of net revenue for simplicity, and it looks like it's coming out at around 3%. Separately for the depreciation, we then do an implied depreciation calculation to drive this forward, and that one's coming out at around 25%. These numbers then need to be plugged back into the P&L and balance sheet. On the cash flow statement, we then add back the D&A, as that is a non-cash expense, and that would increase your cash flows for valuation purposes as well. And then within the financing cash flows, what I've done here is I've just blanked out the other items that probably won't occur once Silver Lake takes ownership. And the last remaining major schedule that we have is for the senior notes, or also known as borrowings. And the way I've approached this is I've combined the current borrowings with the non-current borrowings, so you only need one schedule. We then take the interest expense disclosed in the annual report to calculate an implied cost of debt for the aggregate borrowings. You'll note that if you look into the annual report, EA Games actually discloses each facility and the cost of debt for each facility. Normally, in a real transaction, you would definitely need to build out each of these facilities. But for the purposes of this model here, we can just aggregate everything into one schedule, and this avoids a lot of unnecessary minor calculations. In particular, when we move on to the analysis of Silver Lake's acquisition, where Silver Lake has utilized an acquisition loan, it helps just to have one facility, so we don't need to actually remove all the other facilities later on. Given that EA Games also holds a substantial amount of cash, I've built in some cash interest for the company. Typically, for conservatism, during our analysis, we usually ignore this step and we assume that there is no cash interest, or at least a very low rate of cash interest. Here I'm moving on to the next tab, which is for the valuation of EA Games. Now, you may be wondering, if this is an LBO analysis, why am I doing a DCF valuation? And that's a fair question. The reason why, at least for this video, it's important to do a valuation is to make sure that the implied share price we get is roughly in line with the share price of EA Games before the acquisition, to make sure that our forecast is aligned with what the market was forecasting before the acquisition. Given that we don't actually know what Silver Lake is forecasting, our base case should at least be aligned with what the market is. And once we have determined what that base case is, we can then look at the different ways that Silver Lake could actually increase the value that they get from this deal. You'll notice here, I've also actually assumed a discount period starting at 0.5, and that's because EA Games has a financial year end for March, and this deal was initially announced in September. And so the valuation from the market's perspective, at least back then in time, would have been half a year discount on FY26. Next, we need to look at the actual weighted average cost of capital. And my typical approach to this is you would use the market value of the equity, as that reflects the latest equity value of the company. We never use the book value if it's a public company, just because that does not reflect the fair value at that point in time. And looking at the total debt to the market cap, it's a very low number. And then for the cost of equity, I was actually quite surprised, but the beta of EA Games was only 0.75, which is very interesting. So the WACC comes out at around 2%. And I've just assumed a terminal growth rate of 3% for the forecast period. Some would argue it should be lower, someone would argue it should be higher. Normally what you do is you run a sensitivity on this, just to see how much of an impact it has, which it probably has a pretty big impact. We calculate the terminal value of the company and then discount that value. We then add on the discounted free cash flow to get an implied enterprise value. And once we have that, we adjust the net debt to the enterprise value to get an implied equity value, which when divided by the number of shares gives you the implied share price. Now, what I didn't realize at this point in time was that I actually had an error in my P&L. I wasn't picking up the full interest expense that should have been allocated to the free cash flow, which is why my share price was around $141. And you'll see me correct this at a later point in time. For now, we just keep moving on and we start building in the transaction assumptions for the Silver Lake acquisition. So we know that Silver Lake offered $210 per share, which was around a 25% premium. And typically what you do is you build a sources and uses table. However, with this transaction, we're taking just public info, so we don't have all the information and they aren't disclosing everything. So what we know is that they've offered $210. There's 9.9% stake being rolled in from an existing institutional fund. We also know that the roll-in amount plus the investment amount from Silver Lake totals around 36 billion. And then there is another 18 to 20 billion, which is going to be acquisition loans. I then calculate the actual amount of shares that Silver Lake is acquiring, which is around 90.1%. And given the offer price of around $210 per share, that implies Silver Lake is going to acquire $47 billion worth of EA games. And the other missing component that I had was the transaction cost, which Gemini was implying $600 million. So good on Goldman Sachs and JP Morgan for earning that fat fee. And the remaining amount, I've assumed the additional cash that is being injected, I assume that just goes on to the balance sheet. But you can see here, what I'm doing is I'm actually looking at when the deal closed first. And we know the deal is going to close in first quarter of FY27. And so Silver Lake would only get the cash flow or dividend benefits from that point onwards. Hence, I've put a neat border across the Excel to demonstrate that. And one of the other parts that I had to do was actually adjust the balance sheet for the acquisition impact, which is there will be an increase in debt because you're taking on additional acquisition loans. One thing we need to be careful of here is that acquisition loan typically carry a higher risk, and so the cost of debt for the acquisition loan that Silver Lake is using is going to be much more expensive than the existing 3%. And so Google's telling us, or rather Gemini is telling us, that would be around 5 to 8% and specifically around 7%. And this is actually where I picked up my interest expense mistake. So if I corrected that, I was coming out at $162 per share, which is much more in line with what the market price was prior to the bid from Silver Lake. But you can also see here, when you increase the interest cost of debt to 7%, the company is actually quite capable of sustaining that additional interest expense, which does suggest that it is suitable to be leveraged up significantly. The other adjustments that you also need to make on the balance sheet is the goodwill. Given that the company is being acquired, you would typically recognize an increase in goodwill, given that the acquisition value is typically higher than what is being recorded on the balance sheet. And at the same time, you would write off or reduce the historical values for goodwill, book value of equity, even items such as additional paid-in capital, retained earnings, all of that. I've skipped ahead again, given that I was trying to figure out the adjustments on the balance sheet. But on the cash flow, there would have been an increase in what I would have assumed cash from Silver Lake, as well as debt being borrowed for the acquisition. And the other side of the balance sheet would have seen a drop in the cash amount. So effectively a net impact on the balance sheet and cash balance to represent the acquisition by Silver Lake. We then move on to, I guess, the more interesting part of the video, which is the internal rate of return analysis, the IRR analysis, which Silver Lake would have definitely looked at. And most private equity players would have this as a top priority, a significant priority. Typically, traditional private equity firms would look at a range of 20 to 25% return over a 5-year period. Now, your core plus or your infrastructure funds might accept a lower return around the mid-teens, for example, 15%, or maybe even lower. And so given that Silver Lake is a more traditional private equity firm, we should be looking at something that would give them around 20% IRR, and I would say that should be the minimum base case. So the key line items that you would need for the IRR analysis is actually the upfront cash outflow. So how much money is going out the door for Silver Lake to make this investment. And for dividend distributions, I've assumed that there's none going forward for now. For the exit value, typically for conservatism, you would assume that the entry multiple is the same as the exit multiple. And that is really just to not give any benefit of multiple expansion to the transaction. Because you don't really know if you've acquired this business, let's say, for 20 times now, if it would still be 20 times in the future, or if it would be lower, or it could be higher. So for EA Games, we can see that on an LTM, so last 12-month basis, historical basis, the EV/EBITDA multiple is around 27.5 times. And what we do is we just assume that is going to be the exit multiple of the business moving forward for our analysis as well. We then start to build in all of these inputs into the IRR table to calculate what the return is for Silver Lake. And so what typically happens in a transaction is that towards the end of your exit period, a lot of your value would come from the increase in your exit EBITDA. In the case of Silver Lake, the exit EBITDA in FY31 is going to be materially higher than when they first acquired the business. And so when you multiply that larger EBITDA number by the same multiple, you would still get an increase in value. And that's how you get the increase in returns over time from really growing the business as opposed to getting a benefit from changing industry dynamics, which increase the multiple in that sector. So for conservatism, you would assume no multiple expansion. However, the private equity owner will grow the business. And that is really shown in that final exit year EBITDA number being much larger than what it was when you first acquired the business. As you can see here, the next steps are to essentially populate the IRR table and to take off that exit debt amount, but you can also include the cash amount. Now, what you will see here is that I've actually put in the actual dates across the top of the row. And that is because when you calculate the IRR calculation, an accurate date gives you a more accurate return figure. And so here in our base case, we can already see Silver Lake is expecting an 18% IRR on this investment in EA games, which is pretty good considering that we haven't even overlaid any assumptions around the efficiencies and the cost cutting that they will put through this business. So just based on an increase in acquisition loans at a higher cost of debt, they're already going to achieve a return of 18%. Obviously, our year-on-year full game downloads is growing at 8%, which is quite significant. But really, if you look at the cost side of the business, for example, even in marketing and sales, there is an opportunity for Silver Lake to actually decrease those expenses. And you can see how a minor adjustment in these expenses could actually have a pretty material impact and bring the IRR to above 20%. Especially when you look at the R&D line item, that's the biggest cost expense line item, and changing that really has a massive impact. And once you reduce that, but you can decrease the year-on-year growth and the other revenue line assumptions, you still get above a 20% return. And that just really shows that this acquisition executed by Silver Lake is a really good investment opportunity. Hopefully some of you guys have found this to be a useful video. Let me know what you guys think in the comment section, and as usual, please like and subscribe. Thank you.